This week on the podcast, yet another extra special guest. Jason Wenk is founder and CEO of Altruist, a new artificial intelligence-driven custodian challenging a lot of the legacy entities like Fidelity and Schwab that are stuck with all of their old hardware and software. I thought the conversation was fascinating, and I think you will also. With no further ado, my interview of Jason Wenk. Jason Wenks, welcome to Bloomberg.
My pleasure. Such a great intro.
So I'm fascinated by the through line of your career. You are constantly focusing on creating lower cost, tech-enabled financial advice. But I'm going to put a pin in that and come back. I got to start with your background. You study computer science at Grand Valley State University. What was the original career plan? Was it technology and computers or finance?
So I'd never taken a finance class. I'd never met anybody who had money. My family never owned any stocks or mutual funds. I didn't know what an IRA was, or even a 401k for that matter. But I grew up in the 80s and 90s, so I remember getting our first personal computer in the mid 90s. Internet started to pick up a little bit of speed in the late 90s, and that was my dream, was to go to Silicon Valley, work at a .com. You probably recall the market peaked out around 1999, and then a pretty major crash ensued. So very accidentally did an internship at Morgan Stanley at 19 years old. I was a bit of an odd duck in that I took a lot of college classes when I was in high school. So I was already doing internships, my first year of university. I was presented an opportunity to move here to New York and to join Morgan Stanley. And that was really my crash course in finance.
And you were 19 or 20?
19 as an intern, and officially joined at age 20. Yeah.
So what drew you to financial services instead of technology? Was it simply, the .com implosion and there was no jobs to be had in technology?
Yeah, I was still working in technology. So my role, the internship was like productivity software, but again, just happened to be for a big investment bank. And then I spent about 2 years building different types of technology, like within the Morgan Stanley ecosystem. By the time I joined, they were Morgan Stanley Dean Witter, so they had this kind of big retail wealth business. They also had like prop trading and a number of other divisions too. So I didn't really get too involved into personal wealth until kind of maybe the last 6 months I was there. I was put on a project. We were doing a lot of work with Morningstar, which back then they were still sending out CD-ROMs to branches around the country. And so, if you had a big branch, that'd be hard. Who had the CD-ROM? So we were just building networked versions of essentially the Morningstar database. But I remember around that time, I was doing some like pre-built prompts inside of these like research platforms, and again, the way my mind worked, which was more around math, physics, computer science, I looked at these prompts and I thought, these are terrible prompts. In other words, like the prompt would be, let's build a screen so that financial advisors can easily build a portfolio, and the screen will be something like find funds that have been around for 5 years with turnover under 100% with the same manager for the 5 years or longer. That's in the top quartile of their peer group. And it was when you like on the surface you go, well, that seems like pretty reasonable and fair, but that is no prediction of the future result. That is a terrible predictor of future outcomes, but it was sort of built as though it was a good predictor.
Well, you have the data. Past performance is right there. We have to do something with it. I give Morningstar credit. They had an internal survey that more or less said, hey, don't worry about the stars. The data shows if you just buy the least expensive fund, that's the one most likely to give you the highest level of performance. And to their credit, they published that. I want to say that was like 2011 or 2012. Really fascinating. So you never really rotated through the departments where you're smiling and dialing. Did you ever work as a broker?
So I got licensed. I took the Series 7, Series 8, Series 24, Series 30, like all the classic licenses.
24. You want to be supervised?
I'm not sure why I also like a registered options principal. Like why I did that, I have no idea. Managed futures, like again, not sure why I did that. But yeah, I did all of the research to understand the space. And I did go through the broker training program sort of 2021. And part of it was because I wanted to move back to the Midwest.
21?
Excuse me, 2001.
Okay.
Yeah, a little bit of a mistake there, yeah. And, I think I had this like romantic notion of like going back home and, helping people that I knew. The reality is nobody I knew had any money, so like that wasn't really going to work anyway. And really before I even got started, I made the decision to leave and go start another business. I'm kind of in the space, but adjacent, didn't do direct work with clients.
So let's talk about that. What was the first thing that you noticed in financial advice that led you to say, hey, this is broken, and I think I could use technology to build something better?
Yeah, I mean, so two things in particular. I mean, one was around that time there was a transition from commission-based, sort of sales, brokers, if you will, and there was a transition to more fee-oriented financial planners, and for me that really resonated. So I think this notion of, hey, can you give people more comprehensive planning advice?
And be a fiduciary.
Yeah, and also, I mean, I looked realistically at the way asset management worked, and I thought I very much agreed with the Morningstar study that they published. He said some 10 years later, a lot of this, I'd say goes all the way back to Jack Bogle's work. But I just, looking at a couple of years worth of research around asset management, I didn't see a discernible benefit to stock picking or market timing. Again, high costs, high turnover, high taxes, like these things all eroded wealth. So part of me thought, well, is there a way that you can just get more people access to empirically sort of evidence-based investing? Maybe that will help people do better. The other part was accessibility. Again, I grew up like in a farming town. Really, there were no brokers, there were no bank advisors, there were no Edward Jones offices. Like there was really no access to advice, and I could see the direction the internet was taking us to, really flattening the world. Like everybody should be able to find advice and help, through the internet. So really, the first business was, from an accessibility perspective, it was going to be internet based. It was a subscription service. And it was designed for people with 401ks, because when I looked at the people I knew, that was about the closest thing they had to Wall Street, to a brokerage account, was their defined contribution plan. So the idea was, let's make it easy for people that have a 401k plan to get the absolute best results they can from their 401k. And I spent about almost 3 years building that business. It's
this
like
is
not
Retirement Wealth Advisors.
This is the one that like doesn't exist on my LinkedIn profile. It's
this is before that.
Oh yeah. So I spent from 2021 until 2024 effectively building a 401k subscription business.
2001 to
2001. Yeah, gosh, it shows how old I am. My mix up my decades.
The dates, the names, it's just trends in one direction.
Yeah. So 2001 till 2004, and it was honestly like when I look back at it, it was just kind of like maybe a little bit too early. This was like pre-robo-advisor. Right. Pre-blogging, like pre a lot of things that just got more people connected.
Blogging was just starting around then. We went from GeoCities to things like TypePad.
Yeah, you were a real trailblazer in that group.
Yeah, it was compulsion. I had no choice. I had to.
So the pay-per-click advertising was just coming out. So you had things like Overture, which was like kind of pre-Yahoo, pre-Google, but you could buy the keyword for something like a phrase like how to manage my 401k for a penny, right? And you could be the top ranked, search. People then land on my website, which was called Smarter Than Wall Street back then. And and it would allow you to say, I work at General Motors, answer a few questions, and it would say, here's how to allocate your 401k. They'd get an email once a month if there was anything they should do differently. Of course, the emails never said they should ever do anything differently. And after about a year, I built a pretty good sized subscription business, but I started to have some churn because people were like, why am I paying you every month to just send an email that says the same thing as the email the month before? Right. And eventually I started asking people, well, what would be more valuable? Sort of like a churn survey, if you will. And people would say, look, if you would just do this for me, I'd pay you a lot more than $20 a month. And like that was really the genesis to retirement wealth. And that's even why it was called retirement wealth, because a lot of these 401k folks were retirement focused.
And that scaled up pretty rapidly. That was that the $4 billion advisory shop, or
No,
where did that go?
Yeah, so I ended up going to about 1.1 or 1.2 billion in assets. But yeah, it grew really fast. I started it in December of 2004 was when I got my registration. Ran that for about 6 years, roughly.
$1 billion in AUM is not insubstantial. That puts you into a category,
especially back then.
Yeah, no, inflation adjusted, we're probably talking about $3 billion today, but that's real revenue, that's real clients. What made you say, all right, I've kind of done this, now let's look at formula folios? Yeah,
so I was always driven probably more by impact than by like the size of assets or revenue. That company was bootstrapped. I built every single thing myself, wrote all of the code. It was, although the name was Retirement Wealth, it was a fairly tech-forward platform. I built my own proposal systems to help really analyze a portfolio and then propose a new solution. Digitize a lot of onboarding to really automate getting new clients onboarded. And it was mostly virtual. So it was also before its time in the sense that it was built mostly from blogging, back in like the 2006 to 10 era. So, it was a lot of things it was doing well before its time. And what ended up happening, really the catalyst to moving into the next business was I was invited to speak at TD Ameritrade's national conference. They were my custodian at the time. I loved the people there. They saw the unusual growth and also that I was still in my 20s, and they thought, hey, we'd love to have you come speak and share a bit how you're doing what you're doing. So I went to San Diego. I gave a session where I just said, hey, here's how I'm getting new clients. I'm writing these blog posts. Here's the framework, how I do it. Here's how I take these people then through from a stranger from the internet, into a defined financial planning process, and then a defined portfolio, and it was so structured that I could then train other advisors. And so I hired a few other advisors. They came on, they could then run the process, and so that was the content. And at that time, a bunch of other advisors, I'd say hundreds of other advisors, started to reach out inbound. Hey, how can I get access to your system? They would kind of call it. And the reality was, like, I didn't want to hire 50 financial planners. I've always been a bit reclusive, so I didn't, I didn't want to.
You don't want to manage 50 people, but selling them the software is a fair relationship.
That seemed a lot better, right? So, so just the idea was spawned, hey, maybe it makes more sense to license the software, make it easier for people to run their own business, but leveraging a lot of our technology, and that was the
was that Formula Folios?
Correct, yeah.
All right, and how big did that scale up to?
Yeah, someone went 0 to $4 billion in 5 years, and today it's I think 14 billion or something like that.
So I know that you were a programmer in college. You describe yourself as a developer and a math geek. You very much have a little bit of a hacker mentality. How did that technical, I don't want to use the word self-identity, but just your self-perception, how did that affect your view of here are the services that make sense for investors, for advisors, for this whole ecosystem that has been, especially in the 2000s, mostly ignored by Wall Street? Like, it took 25 years for the fiduciary side to pass the commission-based brokerage side. So how did the technology background affect just your perception of that market?
Sure. I mean, look, I think I've always been a little bit idyllic. You name your company Altruist, you probably have some like generally, idyllic tendencies. But I think I think people who know me well, they would say I'm a bit of a macro thinker, but I don't like working in the day-to-day weeds of most things. So for me, I've always thought in decades, and it wasn't hard to look at the market in the early 2000s and say, well, this is the future. Even though, to your point, like the RIA fiduciary channel back in 2004 when I started my first firm, it was maybe 600 to 800 billion in assets. Today it's probably 10 trillion. So today it seems very obvious, but back then it was a relatively small part of the market. It was not obvious maybe to everybody, but I looked at like the demographics of the country, and just there'd be such a huge number of people who are going to need good quality advice and planning. And that just, again, if you think in first principles, which is a very common technology metaphor, and you have no bias of like the way things had been done historically to say, well, what is the right way to do things? That just seemed like the obvious and only an objective, future for this industry. And I wanted to be, on the forefront of that. So now, some 20 plus years later, the market is, very obvious to a lot of people. They want to build in the space, and it's the place that seems to be growing the fastest. That was crystal clear to me 20 years ago. And I think a lot of that comes from just, again, that more first principle, sort of Silicon Valley way of seeing the world.
Coming up, we continue our conversation with Jason Wenk, founder and CEO of Altruist, discussing how he built the firm to compete with the big guys. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My guest this week is Jason Wenk, founder and CEO of the new custodian Altruist. So Altruist describes itself as a modern custodian, emphasis on modern, for independent financial advisors. What does that mean in the real world? And this has always been such like a boring, plumbing type of industry. What was broken that required your attention?
Yeah, well, I guess the opposite of modern is not modern. So that the whole rest of the industry is pretty old. If you think about most of the infrastructure that's used by financial professionals, the majority of it's 50 to 70 years old.
That's amazing.
And it operates on mainframes, not cloud native platforms. So I think like the starting point is, and with no disrespect, these were innovative companies 50 years ago. They're just not that innovative today. So as far as I get,
you're saying the electric typewriter isn't cutting edge anymore?
I mean, they're still fun to use. The click and
they make a nice noise, right?
It's like it feels very, reminds me of like my grandparents' house in the '90s or something. So look, I think getting to the problem statements, having been in the space a long time. For the longest time, I would look at the industry and go, that just doesn't make any sense. Why do we do it this way, right? So
we've always done it that way.
Yeah, exactly. You're right. Doesn't mean it's the right way. And so some examples of that, I think it's a bit crazy that if you're a financial advisor or wealth manager, and I think if someone's listening to this and they're not one of those people, they'll think this is literally crazy. This is the way it works. But so first you have to have a custodian, right? And this is a place where you'll open accounts for your clients. They'll safeguard your client assets, do all your record keeping, process your trades.
Trusted third party who is not managing the money, and that creates a built-in checks and balance.
Somewhat. I mean, or it could be a built-in limitation, keeping that advisor from doing high-quality work, right? Which is, I think, what I sort of discover as I kind of peel back the layers of the onion. But so these custodians, one would think a very simple thing they should be able to do is, let's say you have 3 accounts with your financial planner. You've got an IRA, maybe a Roth IRA, a joint account with your partner, and you want to know, how am I doing over the past 12 months? You'd think you could just log on to Schwab or Fidelity or Pershing or whatever and just click a button or something, and it would tell you that. But the reality is that you cannot get that information from your custodian. The custodian will only be able to tell you what you have today. It will give you access to your statements. The statements are not bundled at the household level. And what the custodian will tell you is that if you want that type of information, you need to buy a third-party portfolio accounting software. We'll send them a daily file of all of your positions and transactions. That third party will reconcile all of that data, and it will then allow you to run reports for your clients. And you're going to have to pay, depending on the size of your firm, anywhere from tens of thousands to millions of dollars for this third-party software. And like this just fundamentally makes no sense at all. The custodian has all of the data. It should easily be able to reconcile that and run reports for advisors, but they can't and they won't. And you could go down this long list of things that they should be able to do. Again, just like the logic would tell you, for example, if you want to bill a fee to your client signs a fee agreement, says, I'm willing to pay my advisor 1%, hypothetically, and I'm willing to pay them that every quarter, by calculating the average daily balance and bill me in arrears, right? Something simple. Custodian will say, that's cool. What you need to do is we'll send you the data to a third party. They can reconcile the data. You can then run a billing schema. It'll create a CSV file. You can then upload that to our system. We'll then debit those fees from the accounts, but this whole process can take days. And by the time you go to debit those fees, sometimes a client will have had a distribution in their account or a trade or something, and the fees get busted. It creates an account that gets overdrawn. And like, just fundamentally, again, there's hundreds of these things, and you go, this makes no sense. Like, why is this the way things operate? This is largely the genesis to why would you build a brand new custodian from scratch? And if you were going to build it in a modern way, you would probably make sure all of these things are just built in automatically.
So that raises really a fascinating observation. Altruist first came to market 2020, was it?
We wrote the first lines of code in January of 2019, and I think we went into beta in early 2020 and then launched the product right in the heart of the pandemic in 2020.
So I remember when the firm first launched, and I remember hearing about it, and the initial reaction was, I don't want to say crickets, but kind of low-key. Yeah, someone's going to disrupt these 10. We got $10 trillion. We know what we're doing custody-wise. And what started out as sort of a shrug, it didn't take very long before there was a little bit of a freak out. Like, wait a second, what's going on here? They're actually winning clients? How is this a thing? From your seat within building the company, how did you see the rest of the custodian market react to Altruist's launch and to just rolling out one new capability after another?
So there's, I wish I could remember where to properly attribute this to, but there's a great saying that is that first they ignore you, then they laugh at you, then you win. So it's not surprising when somebody has a big, bold declaration they're going to change an industry and make it better. If you're, effectively like a duopoly or oligopoly, as our industry was, almost all the assets were held by, at the time, 3 custodians. Back then it was Schwab, Fidelity, and TD Ameritrade. TD Ameritrade, shortly after we launched, was acquired by Schwab, really making the power dynamic like 2 companies that have 80+% market share. So, respectfully, I think, there's going to be a natural rent-seeking, sort of mentality from those people who are the dominant players. Why would they ever want there to be any change? Why would they want to change their cost structure? Why would they want to modernize their systems? Like, things were great, for those companies. So you're not surprised that some folks may have been dismissive, but advisors never were. Like, when we first started putting prototypes out into the public and sharing our vision, we had thousands of advisors that signed up for our wait list, hundreds that decided to become design partners, like very early kind of design partners help us build the platform. And we have this sort of very loyal base of users that are very loud about how happy they are with the product, and we've done this by co-creating it with the advisors. So it's not lost on me that there are literally thousands of features that you have to build to support the wealth management industry. We can't possibly know all 1,000 internally, so you need to have some awesome partners that can help shine a light on like what are the most important things. So in the end, I think we have more than caught their attention. I think now, there's a fairly deep-rooted fear, actually, from a lot of the bigger players.
Yeah, so you have the 3 big incumbents. It's a little bit of an oligopoly of Schwab, which is now Schwab TD, combined, Fidelity, Pershing, Bank in New York. Everybody kind of looked at them and said, there's no way we're going up against those behemoths. You're one of the first companies to say, we're going to take on the custodians because their legacy platforms just can't do the things that we can do at scale. How do you think about the challenges of going up against, what is Fidelity, 18 trillion, and Schwab is 12 trillion? Like, these are monster. Bank of New York, Pershing is the oldest bank. That's Hamilton's bank, literally. Like, these are not, I think I could disrupt Nokia with a better product. These are just the most entrenched, well thought of partners for advisors. What gave you the confidence to say we could beat them at their own game?
Yeah, I think so. A big part of the confidence came from that early advisor reaction. But the truth is that these companies don't have high NPS. Like, these aren't like loved by their
NPS,
customers. Net promoter score.
Net promoter. Okay. We do one of the surveys every year. And I know that's become super popular everywhere the past 20 years.
You don't have to look very far and wide or have too many conversations to hear wealth managers gripe about their custodians. I mean, again, I was running one of the largest, I think when I stepped down from Formula Flows at the time, it was the fastest growing RIA in the history of the entire industry. We were growing at 16,000%, had a 3-year growth rate. So it was a true rocket ship, in the sense of the RIA space. And I felt tremendous pain. My biggest pain point was my custodian. Onboarding new clients. Again, they were making you download forms from a form library, populate the forms by hand, send them out via DocuSign at best, sometimes requiring wet ink signatures or medallion stamp signature guarantees. Like, it was literally like going backwards in time 20 years. Meanwhile, you had companies like Robinhood that you could download an app on your phone at 18 years old, have your account open in 30 seconds, fund it with $100, and buy fractional shares of Berkshire Hathaway stock, commission-free. I mean, it was so obvious to me that the old way that custodians have been operating, they were still charging commissions using paper. This was definitely not the right way to do things. And if you started looking at the impact to clients, so what is the impact of forcing people to use whole shares? Like, why would the big custodians force you to use whole shares versus fractional shares? Fractional share trading had been around for over 20 years. Well,
it's just math. It's not that difficult to execute.
And this isn't even like hard,
arithmetic.
Geometric algebra,
We're not even
right?
talking about exponential algos or anything like that.
Precisely. But, a lot of it is you just start kind of going, okay, like, maybe this is a good tinfoil hat, theory here, but I'd say, what would the benefit to them be by not enabling fractional shares? Maybe that means more cash will be in client accounts. Maybe they make half of their revenue from the cash spread, right? The net interest income on cash that sits idle in client accounts. Maybe it also forces you, if you do want to use fractional shares, the only vehicle you can use that trades in fractional shares, in other words, you can do notional dollar-based buying, are mutual funds. And these mutual funds pay tremendous fees for distribution through these brokerage platforms. What if they are not allowing fractional shares because they really don't want to disintermediate packaged products in general, right? So make things like direct securities more accessible to more people. I mean, I just went down this rabbit hole, but the end result is it costs investors a ton of money. You end up limiting the amount of tax benefits. You end up increasing the average client account size. So if you really want to have great efficacy kind of investment outcomes, you'd have to have tens of millions of dollars. And if you had fractional shares as just one example, all of a sudden, a ton of that entrenched, kind of history goes away completely. Everybody can get access to the same type of investment strategies, individually, managed accounts, lot level tax trading, so you can get the best possible after-tax outcomes. You can compress cash down to the lowest amount, so you're reducing cash drag. This increases outcomes. So, I think in the end, if you put yourself on the right side of the client, and you have time on your side, like, you will absolutely win. I think one of the best examples of that in our industry is Vanguard. Like, what they did, they were laughed at. And
for decades.
A long time, and they didn't even really reach massive scale for 25, 30 years into their journey. But I think, again, if you just put yourself on the right side of the client, the end client, hey, we're going to do things that objectively and obviously produce better outcomes on an after fee, after tax, after cash drag basis. We're going to provide delightful experiences with a true partnership with our advisor, clients. These things will work. And again, I think you have to have a certain amount of craziness. One of our early investors, you might know, Omani Carson, formerly known as Ron Carson.
I was going to say, Omani is his
name,
post-retirement name.
And I love him dearly. But I remember I met him very early in building Altruist, and we met for coffee in Venice, California, where the company was started. And Omani looks at me after I explained the company, and he's like, pardon my French here, but he's like, this is the craziest effing idea I've ever heard. I'm in. Like, how do I be part of it? I think there's a certain number of people who just, like, we've been doing this a long time. you eventually become numb to the status quo. The status quo was totally shitty, right? It was not good for anybody.
Right.
And so,
except for the custodians themselves.
There was one party that really was happy with the status quo, right? And so I think as soon as we shed a little bit of light, now there's a ton of challenges you have to overcome, but again, there's no doubt in my mind this was going to work when I started.
You mentioned Robinhood and zero commission, which I want to say was 2014 or 2015. And then Schwab rolled out, commission-free trading in 2019. What did that shift in cost structure do to the relationship between investors and custodians, advisors and custodians? Did that change the way everybody looked at this, or was this just, okay, I guess this is an even lower margin business?
Yeah, so I think it's a huge misconception. So what's interesting is that I wrote this piece in 2018, and we had one of our designers kind of draw an infographic kind of behind it, and it was the classic sort of tip of the iceberg where we showed the what you see above the waterline and then what exists below the waterline.
I just did one of those 2 weeks ago, and
great metaphor.
It really is just so perfect to hey, here's what you're focusing on, but you got to look at the things that matter even more.
So we did this for custodians, right? And the thing people saw was the commission. So there was this belief, and advisors even didn't know, the facts. They would go to clients and say, hey, when you work with us and our independent third-party custodian, here's how they get paid. They get paid $7 if you do a trade. It's a pretty cheap price.
What about spreads? What about payment for order flow?
Correct.
I mean, the big money is the commission is just a break even.
100%, right? If you look at the big public companies that were in the space, they were making maybe 5 to 10% of the revenue is from transactions, and commissions were maybe half of the transaction revenue, right?
And that's before we get to the float, which everybody loves.
So there's a ton of things that had, I'd say, historically been ignored or unknown. The biggest revelation when everybody went commission free was people started asking the question, well, how the heck do you make money? How does this business actually work? If you're giving away everything for free, only then did people start to go, oh, wait a minute. That wasn't even how you made money. That was literally just a complete smoke and mirrors way to fool me into believing you only made $7 a trade, when the reality was all of the real money was made by paying me 0.01% interest on my idle cash, making me trade whole shares, which makes me have more cash in my account than I really should, making me buy these different funds that all have a bunch of conflicts of interest through all of their various forms of 12B1 and 15C3 revenue sharing agreements. I mean, just very esoteric stuff that very few people ever talk about. And to your point on float and liquidity through PFOF, payment for order flow, I mean, it really opened everyone's eyes into the fact that the clearing and custody business, turns out it wasn't a high scale, low margin business at all. In fact, it was a very high margin business, and that was just one kind of irrelevant piece that confused people into believing that was the full price of admission.
I recall a couple of years ago, it was after Schwab went free commission, zero commission, free trading. I don't remember if it was TD or Schwab that one of the public companies in a quarterly earnings, 57% of their gross came from the float, came from what they got paid. The difference between what they were paying investors, 0.0 whatever, and the actual rate that they could generate internally. How does Altruist deal with that?
So I think the key is doing whatever you're doing transparently, and whenever you can, giving as much of the economics to the client. So I'm a big believer in, the flywheel, kind of made popular by Good to Great, one of my favorite books. And our flywheel is that the first spoke is invest in innovation that drives better outcomes for advisors. The second is invest in innovation that drives better outcomes for end consumers, the end client. If we do those two things, it will drive the highest satisfaction amongst our user base. This will increase the amount of assets on our platform, which gives us the scale to invest more in innovation, right? So, which drives better outcomes for advisors, better outcomes for clients. If you're going to do that, you have to earn revenue, of course. But in our case, we built a very integrated wealth platform. So yes, we have custody and clearing revenue. We make money on net interest income, the float, if you will. We make some revenue on payment for order flow, but we built what's called the wheel order routing system. It's 100% optimized to drive the best possible execution for every single client transaction. If we happen to get a better execution, through Citadel or Jane Street or whomever, we might make a tiny amount, like literally measured in fractions of basis points, mils. It's the lowest amount of revenue we earn, but like there is something there. We do earn money again on float, but we offer fractional shares. So we have the lowest cash holdings in the entire industry. People can hold virtually nothing. We also have some earnings from things like mutual funds, but we have the lowest amount of mutual funds in the entire industry because we offer fractional shares. So people can buy ETFs, they can buy individual securities. So we have very, very little in way of rev share through fund companies. But there's definitely money that is made at that clearing layer. Where we've really innovated is that we also do all of the software layer, for advisors. We offer an asset management layer for advisors. So each kind of component of the Altruist business is generally going to be 60 to 80% cheaper than if these things were bought individually. So you may recall, when I shared the story about how you go to a custodian and you say, why can't you do my fee billing? That makes no sense. You have to buy a third-party software. We built all of these things natively, and most of them are either free or very low cost because we have this sort of benefit, if you will, of stacking the various forms of services that advisors and their clients need.
On a modern platform.
Correct. And we do it with, I'd say, fairly insane amounts of automation. So, the kind of knock I made on using PDFs, like there's no PDFs necessary at Altruist. Like,
you're not exporting CSVs and then having to upload it to Claude to get
literally ridiculous.
an ROI on
100%.
your quarter or year.
100%. Yeah, you can open an entire family's accounts, do all of their account transfers, link all their bank accounts, and do the whole thing in under 2 minutes. The accounts are being real-time validated. The transfers are being real-time validated. 98+% of these workflows, there's no human being ever involved in them. So every time we build a new innovation or automation, we're able to operate with a much higher amount of operating leverage than anyone else in the industry. This allows us to invest back into more innovation, which allows us to offer more services at lower price points. So look, we earn revenue just like everyone else does. I think one interesting tidbit we don't talk a lot about, but is the fact that on the aggregate, Altruist earns more revenue than I believe any other RIA custodian on a per dollar basis. Meaning per dollar on our platform, we earn more revenue than the big players. And it's not because we charge more. In fact, we have the lowest fee schedule in the entire industry. But it's because we do more for those advisors than just provide custody and clearing. We're offering software and services, AI products, asset management services, automations around things like tax management and tax loss harvesting. So because people use more surface area, we end up having, again, more and more diverse revenue as a business. And we have much better operating leverage because we have so much automation that we don't have to hire a lot of people to actually offer this at scale. So these are a lot of the benefits to modern, right? You do it this way in this day and age, you're not going to build the same way you would if you did it 50 years ago.
You're earning more revenue as the custodian per dollar on the platform, yet at the same time, the advisor is paying less costs per dollar on the platform because they're not working with 5 or 10 third-party add-ons. It's just one turnkey solution.
Correct. Yeah, it's material. And consumers, consumers, if using the platform correctly, are getting better results as well. So because they don't have things like cash drag, because they can be more fully invested, because they can reduce the need for third-party investment products, they can hold securities directly on the platform, reducing expense ratios. Because we have automation around tax management, they can drive down the tax consequences of investing materially. So again, it's one of these things where it almost sounds too good to be true, right? But like, yes, advisors should be able to run more efficient, better businesses. We can have a great business and consumers can win too. Like that is very much a real possibility. There doesn't have to be a loser.
It's a win-win.
In this ecosystem. Yeah.
Let's talk about AI and automation and your platform, Hazel. I know my team loves it. Everybody is super, super positive about it. Is Hazel a standalone AI bed? Is it part of the long-term vision? Is it planning and custodyship and other services as one seamless workflow on a single platform? Tell us all about Hazel.
Yeah. So the basic thought. So first, to answer your question, it's very tightly integrated with Altruist, but it's available totally separate. So really, any wealth manager can use it. We have people using it all over the world in many different industries. So we have large CPA firms that are using Hazel, and obviously large financial advisory firms. So part of the thinking here is that the Altruist business will eventually be a very large scaled business with trillions of dollars in assets, but the total size of our industry is going to be tenfold that, right? So we don't want to limit the power of AI to just the whatever percentage of market share that Altruist has. We want everybody to benefit from these innovations. And so the things that are really cool with Hazel is that, again, it can be used by any financial advisor or really a lot of different segments of financial services. It's been a ton of fun to build, and a lot of what we're doing is just taking the hardest, most like laborious, non-glamorous, but important work that used to really be hard to get if you didn't have tens of millions of dollars. And we're just bringing the unit cost down to like $3 to $5. So you can do like incredibly complex tax planning and do it for, again, effectively like $1 to $5. This makes it accessible to everybody. And AI, people have their fears about, what could go wrong. But we like to think this is a lot of the what can go right.
Coming up, we continue our conversation with Jason Wenk, founder and CEO of Altruist, discussing how he built the firm to compete with the big guys. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My guest this week is Jason Wenk, founder and CEO of the new custodian Altruist. I've seen some crazy numbers as to what advisors manage. I don't want to talk about mutual funds. I want to talk about straight up RIAs who are your prime clients as a custodian, 10, 12, 20 trillion dollars, just crazy numbers out there. What is the total addressable market there, and how much does the oligopoly, the big three, have of that total market?
So the approximate number is 10 trillion today. It's about 35,000 firms. These firms are roughly half are SEC registered investment advisors. This
meaning more than 100 million.
More than 100 million. And then the other half are state registered firms that are sub 100 million. Some of those are just new entrants, like they're just firms that are first registration. They'll probably mature into the SEC within a year or two. And others just, they operate small, independent, businesses serving a loyal but small group of clients. The top of the market, I think it's Pershing gets oftentimes lumped into the big three. They don't have much market share of the RIA segment. It's a bit muddy, but the reason is they support all of the big broker dealers that usually they have a companion corporate RIA, and so that's kind of how they get in here. But true standalone RIAs, 85% of the assets are with just two companies, Schwab being the largest. They're north of 50% market share, and then Fidelity being the second largest. So it's your very classic, disrupt. Like if you were to just kind of say, hey, what would be the recipe for disruption? You'd say big, fast-growing market dominated by old companies using old infrastructure with generally low NPS, like low customer satisfaction. That is exactly the market that we are in today.
Huh, really, really fascinating. So given the fact that you got to build a clean sheet custodian, you're not built on this legacy hardware that can't do all these things fast and easy. What's the biggest take-up from advisors? Where are they still inefficient? Is it just paperwork and portfolio management? Is it tax? Is it compliance? Is it client service and disbursements? Like, where are the biggest advantages? Or is it just the whole thing?
Yeah. So we break this down into like two elements. So, with Altruist, we have our core wealth business. This is like the custody and related software to custody. We started there. It's a super big, hairy build. Like, it just takes a long time, just hundreds of thousands of engineering hours. There's no shortcuts. It's very expensive, time consuming. But
was that a BHAG reference?
Oh,
I heard?
Absolutely. Yeah. Okay. This is like as big and hairy as they get, right? And there's just, again, there's no shortcuts, but that infrastructure is so critical because what it allows you to do, if it's done the right way, is it allows you to tackle all the other work, right? So I'll start with this work, right? The custody part, you can open accounts super fast, do all of the automation around onboarding clients. This is great, but you only onboard a client once, ideally. And so if you serve a client for 30 years, the custody part is really a pretty small part of the picture. It was a huge, kind of friction point because it was oftentimes one of the first experiences that a client would have with their advisor. And if it was a bad experience, like
as it often is,
yeah, it's usually not fast. Like you don't have a lot of clarity. Like, hey, when is my transfer going to be done? Like, why did this thing get rejected? Why am I redoing this paperwork? So we solved a lot of the infrastructure. Now with our AI products, Hazel, we're tackling like the rest of the 30 years, right? So maybe there's, 5% or less of a client relationship that's really connected to the custodian. You're onboarding the client, you're setting up rules around trading and rebalancing and tax management. But a lot of the work really is all of the one-to-one, hard-to-scale work. So you meet a new client, they're a prospect at this point. You need to uncover a bunch of data that they have. You need to then analyze that, build a financial plan, create a proposal. Once they agree to it, then you do that onboarding, and now you have to serve that client for decades. And there's going to be all of these life events that happen, all of these emotions that kind of these folks will live through with you. So it could be massive changes in macro conditions. It could be changes to their family, whether it's death, divorce, new children, etc. I mean, there's so many things that happen. And advisors have to be able to react, ideally be proactive, but react to all these things and make sure your money's aligned at all times. And this is where AI is like incredibly powerful, where you can take a ton of that work that used to be heavily compromised. And compromise is interesting because every advisor, whether they want to admit it or not, historically has been making compromises for the clients. And so kind of one of two directions. Like one compromise is, I want to save the world. I've got a hero complex. I'm going to take every client under the sun. If I do that, the compromise is I can't possibly give the highest level of quality care and service to every client. It's just not possible. You can't earn enough money and revenue from the lower end of your client base. The other compromise might be I am not willing to compromise in the quality and service and attention, but as a result, I can only serve 50 families. And so my minimum is going to have to be $10 million or something like that. Right? So the compromise is I can't actually give my advice to as many people as I'd like to. AI is this great equalizer where we think about all the infrastructure we built on Altruist, and you then layer all of the agents that can do things like gather data for you, build financial plans, build tax plans, help you be incredibly responsive to client emails and questions, to build a level of intelligence across your client base that no human being could ever possibly attain. So it's very easy to have, incredibly precise, and highly personalized, perspective on every unique client that you serve. So these are the things that we're building. I mean, I think in the end, the clearing and custody business will end up becoming very agentic. Like these agents will be the ones who are probably, logging on, if you will, and they'll be performing functions, that today humans have to log in and do. But it's a pretty exciting, time to build.
Really interesting. I recall a couple of years ago, and I don't want to put words into anyone's mouth, but it was the CEO of either BlackRock or Vanguard or somebody that size was asked, what keeps you up at night? And the answer was cybersecurity and fraud. How do you make sure, and I totally understand no one wants to wake up one day and $1 billion is missing. How do you integrate that into Altruist? How do you think about the human element, deep fakes and synthetic identity and voice fraud and cloning and all that stuff? What can the modern custodial platforms do that, hey, some of the big guys don't have the integration with technology to engage in this arms race against the bad guys?
I think the biggest reason they'd have that paranoia is that if you're working on a 50-year-old tech stack. And we see this with like the latest Anthropic model, these kind of Mythos, connected models where, they sit it on top of some, legacy infrastructure and they'll find hundreds of critical vulnerabilities that no human being could have ever identified because the code base is essentially one giant monolithic code base. Like, it is just like this huge albatross that these companies have been dealing with for decades. And replatforming is really hard. If you're already big in your scale and you've got tens of trillions of dollars, it is nearly impossible to replatform and go from physical mainframe-based technology into a cloud-based infrastructure using smaller, more manageable microservices. So yeah, it's a huge risk. If I was running a giant old bank or brokerage, I would have the same probably primary paranoia. If you're building today, the best defense is oftentimes a strong offense. So why not just build, again, in first principles, a bunch of protocols to make it much harder for bad actors to even get in the door? And this is like overstating the obvious, but just having like modern multi-factor authentication and requirement of security keys, even eliminating some of the highest risk, like for example, like phone calls are a lot easier to dupe, ironically, than is a properly built multi-factor authentication program. So, I think there's a lot that will change. We don't, rest on like the fact that, we're a tech company, therefore we're impenetrable. Like, of course, we get we have bad actors trying to come after our clients all the time. And I think that if you're not building especially AI that can help identify other AI and other bad actors, you're in a bit of a quandary. And it's really hard to do that if your core platform, again, has tens of millions of lines of code written in languages that, honestly, nobody uses and hasn't used for decades. That is a major problem with financial services.
So you've raised a decent amount of venture capital money. I want to say the 2025 Series F gave you just under $2 billion valuation. I think I'm in the Series F, E, I don't remember.
Yeah, correct.
Last year. Discuss the need for capital to build out. And we're not talking about the hyperscalers that are spending, ungodly amounts of hundreds of billions of dollars. This is just a nice little startup that's taken on a couple of big entrenched companies and working off a clean sheet. What has the capital spend been like on the technology side?
Yeah, so we've raised a little over $600 million in capital over the last 7 years. I don't think we'll need any additional capital going forward. Like, we still have a lot of cash on balance sheet.
You're cash flow positive now. You're actually,
our broker dealer's been profitable for about 3 years.
Profitable. I wasn't even talking profitable. I mean, just like at least holding your head above it.
Yeah. Well, look, in our industry, every broker dealer's financial records are public. So,
right.
You can go look up our balance sheet. It's not hard to find, but we still use cash on balance sheet for R&D investments to keep building, more tools. But you can imagine if we backed off from, our aggressive building of products and features, it wouldn't be a hard business to run standalone for decades. But yeah, there's a serious cost to start a custodian. So beyond the cost of building all of the technology, there's also the regulatory requirements and the capital requirements. So when you run a brokerage business, every time you add a new client and new dollars to your platform, you have to have reserve capital on your broker dealer. And so there's no shortcut. Like, this is something where I tell people every now and again, they'll ask me like, hey, what would it take for someone to compete? And I say, well, it'll take about 5 years and at least $250 million just to have a shot, just to have any shot in the dark of making it. That assumes, of course, you do it right and what you build is somehow substantially better than anything else in the market, and you can get enough clients to run it on. But just to give yourself a shot, it's like, again, non-trivial. And just to pick up, because you made a comment about these sort of hyperscalers building these foundation models, I'm not so sure that when we look back in 20 years and say, okay, well, or maybe 30 years, 40 years, 50 years, but some amount of time in the future, we look back at what were the most impactful companies that made the biggest difference on society. I'm not so sure those are the ones that we'll be talking about.
Really?
I think it'll be businesses like Altruist that we'll be talking about and going, wow, like they have managed to unlock trillions of dollars for consumers. And that is not something that any of us can be convinced is possible with foundation models yet. At this point, all they are money guzzling machines that have yet to figure out how to turn, sort of inference into profits. In other words, their costs are higher than what they're reselling their products and services for. I'm as big a fan and believer and user of AI products as anybody. But when we really start measuring impact, like what changes the world, that's very possible, but there's nothing proven about it. What we're doing is very proven. Like you can very objectively say, if we give every single client, 1% back in economic advantage, and you scale that across trillions of dollars for decades, you can start measuring your impact in hundreds of billions of dollars. That's, to me, more than like a small startup. Like that's incredibly ambitious, but it's like incredibly good for humanity. I hope more people do this type of stuff.
That's Eric Balchunas's column, which became a book, The Vanguard Effect. I want to say it was like 2016, 2018. Vanguard has saved $2 trillion in fees for clients. I mean, that's an insane number.
Yeah.
And you guys are looking to push into the same space. I want to be respectful of your time before I jump to my favorite questions. I just have to ask one other question. You've built multiple businesses in the wealth management and fintech space. What's the repeatable lesson that carries over from one to another, or is each one a completely different animal?
I mean, these are all pretty connected businesses. If someone looks at like the evolution arc of my career, it's sort of like each time I find a problem, again, metaphorically,
solve it, go on to the next
one.
one.
You kind of go, okay, well, that was an interesting problem, but this is an even bigger problem, and this is an even bigger problem. I'm curious now. I think there's going to be, reasonably good need for a highly specialized LLM, specifically narrowly trained for our industry. I'm not sure the big LLM, so maybe we'll do that at some point in the future. But the point is like there's always something that has the potential to make a bigger impact. And one thing that I'll say, like this, for me again, I don't spend a ton of time. Trying to compare what I do compared to other entrepreneurs. So I can't really say like if there's a lesson to be learned, broadly. But with each venture that I've been involved with, I've started with a pretty simple North Star, which is I want to help people. These are all mission-driven organizations. I'm very passionate about that. This allows you to attract other people that are also mission-driven. These are your more missionaries versus mercenaries. And we have some of the most incredible people that I could never even dream of assembling a team like what we have at Altruist, but it's because they share that same kind of core ethos of serving clients, driving better outcomes, again, sort of being on the right side of the customer, doing things that really matter.
So given that,
it's a huge
out. I was going to say, so given that, look out 5 to 10 years, where's Altruist? What are you doing? How big is Altruist at that point?
Yeah, it's hard to predict with precision like just how big, but I suspect we'll be very large. If we look at the trajectory of the business today, again, we don't talk a lot about our numbers publicly, so people have to sort of like, well, take Jason's word for it, but in our first 5 years of operating, from when we opened our first account, through 5 years, we had more assets on our platform than Robinhood, Betterment, Wealthfront, Public, Stash, M1, Acorns combined, right? So when people wonder, like, is this working? It's scaling very, very rapidly, and it's growing at a really, really fast pace. People, I think, sometimes don't understand that the sort of network effect you get when you serve advisors, and those advisors are growing fast. Firms like yours are growing super fast. The clients are adding deposits to their existing accounts. The market tailwind is pretty material. And
15% a year the past 15
years. And it's better for
bad.
advisor clients than it is for self-directed clients. So these are all things that create enormous tailwinds for businesses like ours. So I think in 10 years out, we'll be multiple trillions in assets serving many millions of end clients. And likely we'll be doing has kind of capped out at 100 or 125 or 150. Like those things, these laws of physics will sort of be removed, and I think that's a net great thing.
All right, I want to be respectful of your time, and I'm going to jump to our speed round. We're going to do these really quickly.
Sure.
Starting with, who are your mentors who helped shape your career?
Yeah, so Nick Beim was our first investor at Altruist. He was also a big supporter of me at my last company. He's a partner at Venrock, and he's just awesome.
What are your favorite books? What are you reading currently?
So right now I'm reading Life 3.0 by Max Tegmark. It's like a book from 2016, 2017. He's a professor at MIT and one of the real forward, early thought leaders in AI. And so he kind of there's 3 phases of AI, and I'd say we're in Life 2.0 right now, still human powered, and get to read the book, you'll find what 3.0 is. It's a good one.
Oh, that's interesting. And you mentioned Good to Great. Anything else you want to mention?
Yeah, I mean, look, these are a little bit cornier, but some of the most important books for me. I'm a total math nerd, so I can live in a Max Tegmark, book for forever. I had to learn a lot of soft skills, to be a better entrepreneur. I learned a lot of those from reading Seth Godin's books, like one of my favorite, amazing books, great blog as well.
Let's talk about what you're listening to, streaming, or watching. What's keeping you entertained on these cross-country flights?
Yeah, so I don't watch much TV. Although I did watch your Knicks. Congratulations.
That was talk about perfect timing and a fairly easy path. Perfect storm.
Avoided my Pistons. I'm a Detroit Pistons fan. But I don't watch a lot of TV. I do listen to a lot of podcasts. So listen to yours. I listen to. I'm a big fan of Henry Stebbings. So 20VC is a good one. I listen to quite a bit. And then I listen to Lenny's podcast. If you're a tech person, everyone who Lenny is, he's a product person that goes into the deep on like how different tech companies are being built, especially kind of product-led companies. So those are some things I listen to a lot.
Really interesting. Final two questions. What sort of advice would you give to a recent college grad interested in a career in fill in the blank, entrepreneurship, fintech, or even financial services?
Yeah, I think in any career, I would become the most AI-forward person in your field that you could possibly be. So it does not matter if you're working in sales, if you're working in tech, if you're working in financial services. I mean, if you can become the person when you walk into the room, you are the absolute master of Claude for your, kind of job function. I think that's one of the most important things for any person. I think young people have an actual advantage there, and it's one they should definitely be leveraging.
You're not going to be replaced by AI. You're going to be replaced by someone who uses AI better than you do.
And it's getting cliche, but it's very true.
And our final question, what do you know about the world of technology, entrepreneurship, or financial technology today that would have been helpful back in the 2000s when you were first ramping up?
I mean, I don't know that there's necessarily some innovation that I wish I knew. I wish I would have spent more time getting proximate to really high caliber people. Now that I'm older and I've done a few things, I've got the chance to meet some just outstanding people. Man, if you can get close to those people early in your career, it's just going to be such a massive accelerant because your way of thinking is going to be so much better and sharper and inspired. So that's what I do.
Thank you, Jason, for being so generous with your time. We have been speaking with Jason Wenk. He is founder and CEO of fast-rising custodian Altruist. If you enjoy this conversation, well, check out any of the previous 648 we've done over the past 12 years. You can find those at iTunes, Spotify, Bloomberg, YouTube, wherever you get your favorite podcasts. I would be remiss if I didn't thank the crack team that helps put these conversations together each week. Alexis Noriega is my video producer. Anna Luke is my podcast producer. Sean Russo is my head of research. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.